Well, it's happening. The markets are crashing. And not just one market, all of the markets. Let me hit you with some quick numbers so you can get a basic idea of what's going on here. NASDAQ is down 25% since mid-February. US 30, the Dow Jones, is down 18%. The S&P 500 is also down 18%. The European equivalent, the German 40 since mid-March, is now down 18%. Bitcoin started tanking in January and is now down over 30%, and the US dollar has gotten so weak that Euro USD has risen from 1.01 to 1.10 since mid-February. This is not isolated to the United States, this is global. Stocks, cryptocurrencies, they are all feeling it. And here's the thing, this might not even be the bottom. Now it feels big, and everyone is hurting. But let's put it into context. Here's how the current drop stacks up to historical drops in the past. In 2020, when we had the C-19 crash, the S&P 500 dropped 34% in just over a month. During the dot-com crash, the NASDAQ fell 78% between the year 2000 and the year 2002. The 2008 financial crisis saw the S&P 500 losing 57% from top to bottom. In 2018, Bitcoin fell over 80% after its 2017 high. Now, we are nowhere near those levels yet, but it feels eerily similar. A sharp drop, sudden fear, feels like a trigger event. And in this case, it's the tariffs and the macro uncertainty. Now, everyone online in the financial YouTube space is throwing around the words recession and depression. The market is reacting to a mix of fear and speculation, with analysts closely monitoring every move. Investors are on edge, trying to navigate through the noise and find clarity in these turbulent times. The sentiment is one of caution as everyone waits for the next big move. The S&P 500 and Dow Jones are close at 18%, but we'll see what happens when the markets open today. They are just below that 20% threshold. A depression is a much deeper 50% or more market drop, long-term GDP collapse, and massive unemployment, like the Great Depression in the 1930s. The market fell 90%, unemployment hit 25%, and GDP was down 30%. Right now we are in the recession zone, not depression territory. But it's a fine line if things continue to escalate. The current economic climate is marked by uncertainty. While some indicators show resilience, others suggest potential trouble ahead. It's crucial to stay informed and prepared for any scenario. These tariffs will raise the costs of goods for businesses, which more than likely will be trickled down to the consumer. Importers pay these tariffs when they bring product into the United States, and they increase the price of those goods to the consumer to offset the costs of those tariffs, cutting into profits and fueling inflation. Now, these new tariffs entice a risk of trade war retaliation, especially from larger countries like China. We raise the tariffs on them, they raise the tariffs on us. We retaliate with more, they retaliate with more. This cycle of retaliation can lead to significant economic disruptions, affecting everything from stock markets to everyday consumer goods. This isn't just logical thinking, it's emotion. And when people sell emotionally, they almost always lose. And this is very bad. It's very bad for everybody. It's bad for the economy. It's bad for the consumers. Cost of living goes up, hyperinflation happens during these types of markets, the dollar loses its value, everything gets more expensive, and it just is a catalyst to really bad. After the 2008 crash, the S&P 500 rose 400% over the next decade. After the C-19 crash in 2020, markets hit a new all-time high within 5 months. Buying during crashes has historically outperformed waiting for the recovery. Warren Buffett says it best, be greedy when others are fearful. So, looking at the historical data, bad things happen, and then everything gets better. And this happens time and time again. So, what should you do now? Do you sell? Do you panic sell? Do you panic buy? Do you stay out of the market? Scene 4. Investment strategies. When it comes to investment strategies, diversification is key. Spreading your investments across different asset classes can help mitigate risk. It's also important to stay informed and keep a long-term perspective. Remember, markets are cyclical, and patience often pays off. Stay calm and invest wisely. That's where the most profits are made. Emotions are the enemy and logic is your ally. Fortunes, unfortunately, are made not when things are calm, but when there's panic and blood in the streets. That's always how it's been, and that's always how it will be. Go against the herd and you'll probably end up better than that. Navigating market volatility requires a steady hand and a clear mind. When the market is turbulent, it's easy to get swept up in the chaos. However, this is precisely when you need to stay grounded. Understand that volatility is a natural part of the market cycle. It's during these times that opportunities arise for those who are prepared. Diversification is crucial. By spreading your investments across different asset classes, you can mitigate risks and reduce the impact of any single market downturn. Additionally, maintaining a well-balanced portfolio ensures that you're not overly exposed to any one sector or asset type. It's also important to stay informed, but avoid making impulsive decisions based on short-term market movements or sensational news headlines. Stick to your investment plan and trust in the strategy you've developed. Remember, the market has always recovered over time, and those who remain patient and disciplined are the ones who ultimately benefit. So while the market may be volatile with the right approach, you can navigate through it successfully and come out stronger on the other side. This crash isn't random. Yes, all of the news and politics entice this crash, but it happens consistently. There's always something in the economy of the world that causes it to go down, whether it's housing, whether it's the dot bubble, whether it's a war, whether it's C-19 or some other pandemic. There's always something. The market will go up and then bad things happen, the market will go down. It's a cycle. As we navigate through the ups and downs of the market, it's essential to take a step back and consider the long-term view. Historically, markets have shown resilience and a tendency to recover over time. This is evident in the patterns we've observed through various economic cycles. Investors who maintain a long-term perspective often fare better than those who react to short-term market fluctuations. By focusing on the bigger picture, you can avoid the emotional pitfalls that lead to hasty decisions. Remember, the market is a marathon, not a sprint. In the grand scheme of things, the market's trajectory has been upward, despite periodic downturns. This long-term growth can be attributed to factors such as innovation, productivity improvements, and economic expansion. Therefore, while it's crucial to be aware of market crashes, it's equally important to recognize the potential for recovery and growth. Stay informed, stay patient, and stay focused on your long-term financial goals. Now let's delve into some of the most significant market crashes in history and what we can learn from them. The phrase in day trading is, when in doubt, zoom out. And when you zoom out over a long time frame, you see the market just goes up. Yeah, there are crazy dips like all the time gas crisis, oil crisis, pandemic crisis. These things just happen and they're aggressive and they're super fast, and on paper, you've lost a ton of money. When it comes to personal investment strategy, it's crucial to have a plan that aligns with your financial goals and risk tolerance. This strategy should include diversification across various asset classes to mitigate risk. Regularly reviewing and adjusting your portfolio ensures that you remain on track to achieve your long-term objectives. By staying informed and disciplined, you can navigate market fluctuations with confidence and make decisions that support your financial well-being. I watch crypto way more than I watch the stock market. So, when I saw massive overbought territory in Bitcoin and crypto, I got out of my positions 100%. But I kept my stock portfolio going, and it's just a long-term ride-it-out investment. And obviously that's all down 30%, 30% because I'm a majority in Nvidia right now. Overall, like if you're thinking about a stock portfolio, it's a tough market, but I'm holding on. GAP 3S. Now let's talk about diversification. It's essential to spread your investments across various asset classes to mitigate risk. For example, while I have a significant portion of my portfolio in tech stocks, I also invest in other sectors like healthcare, real estate, and even some international markets. Diversifying your investments can help protect against market volatility and ensure you're not overly reliant on the performance of a single sector or asset class. Remember, diversification is key to building a resilient and balanced portfolio. So I bought more to dollar cost average, and I'm just gonna buy my way into this dip and then ride it up to new all-time highs because I got back in at a discount of what it was before. That's what investing is. So, if you're hurting right now, don't sell. If you did sell, rethink that choice. Investor psychology plays a crucial role in how we navigate market downturns. When the market dips, fear and panic often dominate our decisions, leading to emotional selling and significant losses. But understanding the sentiment behind these moves can offer a strategic advantage. Remember that markets are driven by human emotions, fear and greed. During downturns, the collective fear can cause a snowball effect, pushing prices even lower. However, seasoned investors know that these periods of panic can also present unique opportunities. By staying calm and focusing on long-term goals, you can turn market sentiment to your advantage. So, how do you maintain a steady hand when it feels like the sky is falling? One key strategy is to remind yourself of your investment thesis, why you chose certain stocks or assets in the first place. This can help you stay grounded and avoid making impulsive decisions based on short-term market fluctuations. Additionally, maintaining a diversified portfolio can cushion the emotional blow of a market dip. When you spread your investments across different asset classes, sectors, and geographies, you reduce the risk of any single downturn wiping out your gains. In the end, the most successful investors are those who can manage their emotions and stick to their long-term strategies, even when the market is in turmoil. So take a deep breath, review your investment goals, and remember, this too shall pass. Timing the market is something 8 people on planet Earth can do. I'm assuming that you're not one of them, because I'm not either. So let me know in the comments, are you going to buy this dip? Or are you going to wait it out? Or are you going to dollar cost average this entire crash? If you got some value out of this video and it helped calm you down a little bit, smash the like button. I'm going to be watching the market when it opens today like a hawk, and I will see you in the next one. Thanks for watching.